Hello everybody, it's Mcclendon. This video is going to be about the 5 type of orders types for stocks and how you guys can implement them in the markets. Let's get into it. So we get 5 types of orders. I'm going to do the easiest one, is market. So a market order is very simple. What you're doing is, if you're going to buy a stock, let's say it's going to be stock X or stock X, and it's at $5. What a market entry does is saying, hey, I want to buy X amount of shares at current market price. So let's say you want to buy 10 shares at market price at $5. So what a market price guarantees is that you get 10 shares, but not all at $5. Depending on how volatile the stock is, if you put that order in and it goes through, and now instead of being at $5, you buy each share at possibly $5.01, or some maybe you buy all the shares at $5.10. There is a spread, and there's volatility, so the market will move. So from the order to be placed in that you put in, you'll get your 10 shares, but it might not be at the same prices that you like. And that's what a market entry is. Let's go on to the next one. Now, our next 2 order types are going to be buys. We're going to look at the 2 types of buy orders. So we have a buy limit and a buy stop. So how do you guys implement them and what do they mean? So a buy, which is meaning that you want to buy at a certain price and make the market price go up, that's what typically it means. So that's what a buy means. But for a limit and a stop, they act a little bit different. So let's say here's your stock price, and that's going up and going this way, right? So and it goes ultimately this direction. So what a buy limit does is that you want to buy at the cheapest price. Okay? Let's say this. You want to buy at the cheapest price. So you say, hey, if this stock price is at $5, if this stock price is at $5 and it's bouncing around, this is 5, this is 7, this is 3, this is 6, this is 9, and ultimately this is 10. Let's say 15. Cool. Goes up. So what you want to do is understand, like, this buy limit, you want to buy at the cheapest price. So you're saying that, hey, I'm going to type this into my broker and be like, hey, if the market hits this price of $4, it's going to enact me into that trade. So just say this. All right, we're different color. The market's at $5, goes up to 7, and comes back down, and you place an order of, say, 5 shares at $4. When the market price hits this point here, if there's enough liquidity, your shares will enact at that $4 the $4 price, getting you 5 shares. So you're doing a buy limit to buy at the least price right here. Boom. Hits the $4 mark, goes down, $6, boom, and keeps on going. And now you're in for 15. You get 5 shares at $4 and the price is 15. Now this is a hypothetical situation, but what's a buy stop? Buy stops are really important because instead of, you know that the trend is up. Let's say I understand the trend is up, but you want to make sure that you're not getting trapped, right? You don't want to you want to do a buy stop because you think the market's trending at 7, so you're going to go down. And you don't want to be down here. You don't want to be down to 3 or 4. You want to make sure you get in with the trend. So you're going to say this. I'm going to put an order in right here. And this is going to be also at 5 shares, right? 5 shares at, say, $8. So what it does is it can protect you. So if the market shoots down lower and lower and lower, let's say to $1 or $0, or really, really low, about maybe in the change, it protects you because if it goes down here, it doesn't affect you. But if it hits the $8 mark like it did here, now you're in the trade. And then if it carries on higher, you get in the direction of trade. So buy stop implies that you're going into a directional trade. Cool. So those are buy stops and buy limits. Now our next two are going to be sell stop and sell limit, and let's get into that right now. All right, guys, we're going to go to our next two: sell limit and sell stop. Let's check this out. So a sell limit and a sell stop, what that is going to do is get you into a selling position. Now, this is for when you're shorting the markets. You can also do this in forex, and you can also do this in stocks. They both apply. So just say this: you get this market here. All right, it's been flat. It's going to go up, and then head back down to here. Cool. First one we're going over is a sell limit. So remember, it just implies a sell. You're selling down into the market. So the first one, the limit. What is a sell limit? So a sell limit is going to tell you that if the market is trending up, you want to make sure that you're going to get a certain price. Let's say here. And you're going to go for, just say and stop, and you're going to sell a position here. And this is the price is over here. Say this is $5 once again. That's $5, and this is a $10 position. So you want to short the markets. You think that at this $10 valuation, $10 price is too high. It's overvalued. It's overbought. It's going to get into selling position. So you're like, okay, when the market is trending up to this point here, if the market ever hits your $10 point or here, you enter in your position for a short market down, and you'll take gains on that market down. Now, yes, you can make money when the market goes up and down, but that's also getting the cheapest price for a sell position. Okay? So what is a sell stop? Similar to a buy stop, just like a sell limit, but a sell stop implies that the market is trending at a certain point, and that's where you want to go into. So right here, this is the market is taking off. Cool. You put in your sell limit, your sell stop at this price here. Just say this is at the $6 level. So if the market is up here, trending past your stop or your sell stop, if it's up here, your order does not enact. You're not in the trade. But until this market goes down and hits this $6 price, then right here, you're in your trade right here, depending on what your size is. But when you're shorting the markets, now you're like, okay, I'm in that sell stop, and it goes down and keeps on going down. You're actually taking gains off that. But there's benefits to both, because on a sell stop, it protects you, because if the market, say hypothetically the market does not do this and just trends up and trends up, it protects you because the market didn't hit your order and you don't take any losses. A sell limit protects you too, because if the market instead of going up at this price and it keeps on going up, you can protect yourself at this price here with a stop, which I'll go into a little bit later, but in another video. And it protects you because you limit how much risk exposure you have, and also you can get the best price at the best price for shorting. So those are the 5 types. You have market, you have buy stop, buy limit, and you have sell stop, sell limit. If you have any questions or comments, please contact me or our support staff and about this. And I'll see you guys on the next training session. Have a nice day.